We will address as many questions as possible during the Q&A session. Okay, good. Our first speaker, introduction, Hsien-Hui brings with him in-depth knowledge and experience in the business development and venture capital space across Australia, Europe, Singapore, and the US. As the head of venture investing, Hsien-Hui oversees SGInnovate's investment efforts, which target high potential deep tech startups working on areas such as artificial intelligence, autonomous vehicles, medtech, and blockchain. Prior to joining SGInnovate, he was the managing partner, Asia Pacific for Wasatch Ventures. He has also served as the CEO of the National University of Singapore Society and USS and vice president at Staples. In the early 2000s, he co-founded a data mining company which was later sold to a global bank 2 years later. Hsien-Hui is a graduate from NUSS. He graduated in 1998 with a Bachelor of Engineering. May I now invite Hsien-Hui to take charge of the screen. Hsien-Hui, please.
Okay, can everyone hear me? Right. Let me get started. I think it's, I'm trying to find the video. Oh, okay. So it looks as if it's just going to be audio from my part. First of all, let me thank Dick Wee for inviting me to speak at this very fascinating and very interesting event. When it was first given to me, I was very excited and I thought that there would be plenty to talk about. What I did not foresee was that there's so much to talk about that I would have had to really try to trim it down and focus on what I really know and less about what I'd like to talk about, over beer or during a happy hour. So I'm going to focus on the technologies that are emerging post-COVID-19, and hopefully, there'll be more questions later on that we can delve into specific details. But I'm just going to give a broad overview of that. Sorry, I'm trying to change the... Okay, so I think a good starting point is actually to establish the frame or the limitations of this, of what I'm going to be speaking about. Because if we go too far into the future post-COVID-19, then you're going to start to see a lot of these fluctuations the economic fluctuations start to time. You're not going to see any real habits being formed that is going to lead to long-term entrenchment of certain technologies. So the first assumption I'm making is that the next 12 months, no mass vaccination is going to be, some scientific support for this, in the sense that there is no true vaccine that has been shown to be both safe and effective at this stage. And given the period of time taken to evaluate such medications and such therapeutics, it is unlikely that within the next 12 months, a mass vaccination. As such, then we will then have to assume that social distancing becomes the norm. For companies, this will imply that work processes need to be restructured so that they continue to gain the same levels of productivity and efficiency as if they were working together in the same organization. More importantly also is that professional and social activities are likely to be constrained to within national borders. For those who have actually, for those of you who have actually read some of these reports about the airline industry of the future, post-COVID-19, I think some of these are real horror stories where you've got to go to the airport 4 hours before the flight takes off. And then once upon landing, you probably have to quarantine for 14 days. This is going to put a huge damper on business travel, at least for the next 1 year or so. Inevitably, this is going to lead to the closure or merger of companies that find it hard to adapt. But at the same time, it's also going to lead to rapid growth for companies that see opportunities that this technological transformation may help to support. What are the implications of this? The first is that obviously there's going to be economic insecurity. When you read news that companies are closing down, retrenching workers, even though you yourself may feel secure in the kind of job that you have, that your company isn't laying off people, that the business is still pretty much as usual, you cannot help but feel a certain sense of economic insecurity, and this will lead you to make buys that made previously. There's definitely going to be more attention to wellness and hygiene, where previously it was more polite society requires you to shower every day, to wash your hands, to wear a mask and all that. Now it could be actually fundamental to your overall well-being and your ability to combat the impact of some of the other illnesses that arise from it. More importantly, this COVID-19 pandemic has actually helped to open up people's minds to looking at new ways of getting the same things done. So what do I mean by this? Companies, I'm sure if all of you have worked in companies, you realize that it's really very difficult to get new things done because there's always a lot of bureaucracy. There's a lot of management is always saying do some more research, show me the numbers and all that. COVID-19 and the hard stop to the economy has forced companies to wait the outcomes later on, and if it doesn't work, we are just going to throw it out. If it works, let's continue doing that. So I think this webinar is one of the examples of how NUSS is also changing its way of launching its engagement with members, and I think this is all very positive. The last item, the implication is that home becomes a center of the individual. It has now become something like, it's not just your personal space, it is also your workspace, it is also your school space, it is also your gym, it is also your entertainment center. So the home becomes more important, and now my video is on. And the ability of the companies to deploy their solutions and their products to their customers' direct importance moving forward. So what are some of the technologies that are supporting these trends? These technologies trends are not exhaustive by any means. There are technologies that are over and above this, like 3D printing and all that are gaining traction in certain areas of the market. But I'm broadly giving, we're going to talk about 10 trends, which I think are going to be important. As we move towards digitization and a more technology-focused lifestyle, your digital identity is going to be one of the key factors needs to engage with you and your ability to interact with them. So companies or the government that has got to develop a digital identity that is both secure and is validated as being secure by not just Singaporeans and Singapore companies, but also the global community, because that is how the new reality is going to be like. Secondly, cybersecurity, information flowing across unsecured networks, with more people using unsecured Wi-Fi networks to work, to transact, to do their banking transactions, to pay for things online, then cybersecurity is going to become a key factor. And there's going to be a very strong push to vendors to tighten up the way in which they write their code in a lot of the applications that they have. At the same time, also cybersecurity companies that can monitor the broader cybersecurity landscape. Obviously, devices is going to be important. That is the user interface between you and the digital world. It does not just mean laptops. It doesn't just mean smartphones, but also encompasses things like sensors and quite a lot of other things as well. So devices at the moment have always taken a backseat to a lot of the face-to-face interactions that we have. But I've seen some quite interesting technologies in the areas of holographics. Unfortunately, the equipment is a little bit too wealthy at this stage. But devices is going to become key, and with devices, the whole plethora of technologies associated with chips, development, energy storage, and the like. Communications is basically the bread and butter of anything that is technology centric. Without communication networks, without 5G, 4G, without the Wi-Fi, nothing is enabled. You'll be stuck watching terrestrial TV for the longest time. So communications is going to be one key area, one foundational technology that is not likely to go away. COVID-19 or post-COVID-19, it makes no real difference. Medical technology seems an obvious technology to be developing. But I thought to put it there front and center, not just because of the COVID-19 case itself, but also because how COVID-19 has forced the medical fraternity and the pharmaceutical fraternity to look closely at their own methodologies, at their own ways of doing things, where they've always done research in silos. Now they are being forced to share data, to co-develop solutions to address this terrible virus that is afflicting the whole world. At the same time, organizations like the FDA, CFDA, and the like, who traditionally would not allow a drug onto the market for from 6 years to 10 years, especially the novel drugs which are new to the market, simply because they need to establish a lot of clinical trials to ensure safety, efficacy before they launch it. They're relooking that process because they need to start to launch more drugs more quickly into the market, even if the tests are not complete. And how they are able to complement these physical clinical trials is through the use of artificial intelligence to generate more cases, to look at broader trends that may not be apparent to the naked eye at first glance. So medtech is going to be very important. It has been important in the past, it will continue to be important in the future, and maybe more so simply because there are more, it's going to be easier and faster for companies to innovate in this space. Fintech is another area of technology that is growing quite rapidly. Contactless payments. I'm not sure how many of you in the audience today have gone to the ATM more than once a week to draw cash, because a lot of the transactions, cash-based transactions, are being done away with. The physical cash itself can become a vector for can become a transmission mechanism for the virus itself, and it's actually not a safe way to transact. So therefore, there's a lot more transactions that's taking place, on the internet and the like. But then that relates back to the cybersecurity aspect of it. For those in the audience who are parents, I'm not sure what your thinking is around the current state of edutech as relates to home-based learning. I think some of the feedback I've received is that while every company in the edutech sector is trying its level best during this home-based learning period, everyone was sort of caught by surprise, and a lot more could be done to enable better engagement with students and teachers within the community. So I believe that post-COVID-19, more discussions will take place both in the private domain as well as in the public domain to determine if home-based learning is an alternative or can be complementary to the current school classroom-based learning. Content creation is also something that is being looked at quite seriously. Content creation, not just from the ability of people to cut videos and the like, but also from the animation perspective. There's a thought that the ability to make movies is going to be limited in a post-COVID-19 world, simply because you can't get big groups of actors, actresses, and their supporting cast and the like all together. They become almost like clusters of potential COVID-19 spreaders. So there's a serious discussion ongoing as to whether or not they should put on hold a lot of these movie creations, movie shooting that's been planned over the course of the next 1 year. So content creation may likely take the precedence will likely be taken by animation during this period, and how it is distributed and sent out to the individual or to the consumer is also under discussion. Looking at different business models, because cinemas are themselves dangerous at the moment. A virtual reality is something which is not really mainstream. It is more on the B2B side of things, where it is used by architects as well as developers to try to, who may not be in the same country, to try to continue to build or continue to amend certain designs in the buildings in real time without having to actually be on location. And finally, on the automation side, I think automation is something that we all know about. it is, we have automated the process of buying things online. We have automated the process of grocery shopping. We have automated the process of food delivery. And I think with more and more companies coming on board with this automation process, it is unlikely that post COVID-19 that all this will go away once this lockdown is lifted. So I think the lockdown and this and COVID-19 has really accelerated the growth from adoption to entrenchment in front and center in the mind of a lot of people. Now, I'm aware that my time is getting short, so I'll just quickly go through this. This is just a mapping of what I just discussed, which is we have looked at foundational technologies like digital identity, cybersecurity, communications, and devices that will continue to be important, whether or not we find a vaccine, and which will basically drive a lot of the new content, business models, and technologies that are being built on top of it. Okay, I realize that I've overstayed my welcome a little bit, so I'd like to thank everyone. Hope everyone stays safe, and I look forward to the discussion later on. Thank you.
Thank you, Hsien-Hui, for the insightful sharing. Yeah, things have really changed since the COVID situation has gone into the international landscape. Right, so next we will be doing our survey. Proper survey now. Can you flash the questions, please? Right. We have 3 questions. What kind of insurance would you use your last dollar, that means whatever you have, to procure after this pandemic situation? Would it be hospitalization, unemployment or business disruption insurance, travel insurance, or life insurance? Question number 2, what area of your life is your immediate concern? Business, employment, health, social life, or basically skills future, training and upgrading your own skill set? Lastly, what's the choice of mask you would use? Reusable or disposable mask? Okay, webinar is a little bit interesting experience for all of us because we can't really see that response from the audience. But right, anyway, here it goes for the results. More than half would definitely procure hospitalization insurance. Right. For survey number 2, what area of your life is your immediate concern? Definitely in today's context, everybody thinks health is most important. Of course, the next will be employment and business, without a single doubt. And majority of the users of masks are actually environmentally friendly. 61% prefer to use reusable masks. Okay, great. So let's move on to the next speaker. Our next speaker, Jeffrey Khoo. He's the Chief Marketing Officer, APAC, of ED Broking Asia. He's also a prominent influencer in the agriculture sector. Jeffrey has worked for over 20 years in various senior roles, including Asia Head, Food and Agriculture Sales at Swiss Re, Director with Caltex Asia, a private equity firm, and a General Manager of Guangzhou IFC, SGX listed company. Jeffrey graduated from NUSS with honors in botany in 1994. Let us now invite Jeffrey to share his perspective of the post-pandemic era. Jeffrey, please.
Thank you, Hsien-Hui, and also for that earlier speech, and also thank you for inviting me. Right. Hello. Can everyone hear me? Tegui, can you hear me?
Yes, please continue, Jeffrey.
Okay, right. Great. Okay, good afternoon, everyone. I'm speaking out of my home, so I guess most of you will be at home also, right, at this point of time. Now, when we're talking about insurance, right, insurance is actually in probably every business line in the world. It is much more than the life insurance that we all are sort of used to it, right? It actually is in many, many different facets of businesses across the globe. So let me dive straight into it, right, as to how it's going to affect globally and also Singapore. And I have to give a global perspective also because Singapore is definitely going to be affected by it. Now, it's unavoidable, right? Okay, it is unavoidable. Let me try to move this backwards a bit. That's okay. That COVID-19 will affect a lot of insurers and both clients, right? Now, but the full impact, I must say, is still not clear because, you know, the claims are trickling in. Now, most of us are just, you know, like you and me are now at home. So the impetus to go out and try to get your claims done up, you know, it's not the priority at this point of time. But definitely by Q3, by Q4, all this will start coming in. And there will be large amounts, right? Because it's not only life insurance, there's business interruption, trade credit, and so on and so forth, right? So, but, you know, amidst all of this, you can see that some governments are helping out. They are pumping in some money into these companies and in order to actually keep them afloat, right? So the overall view is that the insurance companies, the insurance market has, the valuation has pretty much dropped. Fitch Ratings has given it a negative rating for most of this year already, right? So it's not a very pretty sight for the insurance company yet, but how ugly it can get, it's going to take a while before we see it. The road ahead, what we can see now is that different lines of business. Okay, so for insurance, like myself, I do a lot of agriculture, there's life insurance, there's business interruption, there's trade credit, casualty, property insurance. So there are very different kinds of lines of insurance, right? They're all impacted differently in different countries, right? Now, there's an underlying understanding here, and I think that when I start this, this seminar or this speech with you, right, is to get this one thing clear: is that higher claims at the end of the day, with higher claims, it means lower capacity. What does that mean? So there are many massive losses in the market, right? A lot of claims and all that, billions of dollars. You have lower capacity. Now, let me give you an example. For example, you are an insurance company, and you can insure up to 100 million, meaning that if anything goes south, you can pay $100 million. After all the claims have been brought in, after they have been cleared, maybe you can only do 50 million the next time round, right? So capacity has changed, which means that you can insure less in the market than you normally would. So that's not a good thing, right? Which means that certain deals cannot be done because they are not insured. So this impacts Singapore in a way because we are a trading hub. And of course, finally, with all of this, the remaining 50 million in the example I'm giving you, that cost of capacity will increase, meaning that your premiums will have to increase, right? So this will be inevitable, but the impact will be different for different lines. Now, there are three waves of insurance that I would sort of define as happening. Now is the first wave, which is a reduction in demand. No one is, your life insurance, a salesperson cannot come and sell you policies. If there are new kinds of policies, it's pretty difficult to market now, right? Nobody's really ready to do this online marketing as yet, right? So most lines of business will be affected, right? Cancellations, maybe a few. In terms of renewals, yeah, that will pretty much slow down, right? So you have a reduction in demand. Now, the second phase will be the increase in claims, which will come later, right? All the claims will come in for losses, event cancellations, trade credit, property, whichever, right? Life insurance, all that will come in. That was the second wave. And the third wave is the more positive one, right? Because a greater awareness of insurance has happened. People that usually don't buy insurance for their business, for let's say a pandemic cover or so, or they'll start buying some, right? And life insurance and health insurance particularly, right? So all this will come in phases, right? So let me talk a little bit about commercial insurance. Singapore is a trading hub. We do a lot of business here, right? And a bulk of it is, you know, a lot of money moving in and out, a lot of goods moving in and out. So there's this thing called trade credit. Now to put it in a very layman's term, if I was, let's say, selling, let's say, 1,000 of these iPhones, right? And I sell it to someone, and there's a 30-day credit, right? And after that, what happens is that he doesn't pay out because of COVID-19, right? So there is where insurer comes in, and the insurer will pay up on behalf of that client of mine, right? So a lot of these will happen, right? So we have, I mean, it could be just simple handphones, it could be anything actually. So, but these are big ticket items where a particular party, a customer defaults on payment, cannot pay, and the insurer has to pay. So this adds into reducing the overall capacity of the insurance market. The second one is events cancellation. I'm sure all of you know the Olympics, the concerts, the large-scale concerts, all be impacted, right? Not so much of the small ones. Most of them are not insured. For example, now we're doing this in NUSS. We're not insuring this one, right? So, but larger ones, generally they're insured. Then business interruption, factories, anything that's got to do with operations and all that. Now, they will also be impacted. So there are all kinds of business interruption claims, but interruption claims generally exclude infectious disease, extraordinary events, forced business closure. They usually do, but not all, right? Not all. In fact, it's quite interesting. I just saw on the net today that a particular business interruption cover has just stated that, okay, we will have to remove this particular benefit, I would say. And it says outbreak of infectious and contagious disease to be excluded, right? And lastly, of course, is workers' injury, right? So employees who are infected by COVID-19, right? There can be some claims. Now, of course, this depends on which country. Like in Singapore, right? It is covered by the government, right? They are actually picking up the tab for this. But in other countries where it's not covered, the insurers have to step in and pay for it. Now, personal lines. What are personal lines? Personal lines are things like your car insurance, your house insurance, theft insurance, and and all these, right? Now let's talk about where are the positive bright spots. Now for car insurance, neither yourself, I think, or myself, you're not driving around at this point of time, or if you do, it's just short drives. The odds of an accident are a lot lesser, so there'll be lesser claims in this area, right? You don't have too many accidents, right? Then in terms of let's say property theft, your house going on fire and all that, it's a lot lesser, right? Because you're at home, right? I mean, if there's a small fire, you can stop it. Definitely no thief is going to start walking to your house now, right? Now, what's the downside of it? All this, of course, lesser claims, right? The downside is that renewals will be definitely delayed. People, are not so incentivized to want to pay their renewals now, and there's limited new business. It's going to be pretty hard to actually sell an insurance policy, a new one during this time, right? Things like travel insurance, the earlier part before the lockdowns, there'll be a lot of that claims, right? Flight cancellations, hotel cancellations. So all that will come into play and add into affecting the entire capacity of the insurance market, right? Okay, now coming closer to us, life and health insurance. There'll be a lot of critical illness, hospitalization, death claims. Now, this also depends on which country you're in, right? For example, in Singapore, COVID-19 covers all Singaporeans, permanent residents, long-term pass holders, provided that after the 27th of March, going out and then get infected. If you come back and get infected within 14 days, you're on your own. There's no subsidy for that, right? The second thing that you will face actually is a change in renewal terms, right? So as I might have alluded to the fact that insurance companies are still profit-making companies. They have to find some way to sort of become profitable. They've got shareholders, some they're listed. So the renewal terms will change. Maybe your current one won't change, but the renewal ones will change to look at COVID-19 as an event that will have massive losses for the insurance companies, right? So other companies are not. Other countries, they don't have or they don't buy. They don't have the government coming in to help out, right? So the thing is that private insurers out there will have to actually pay out for all these costs. Yeah, but I guess the upside of it, or I would say, is that for the insurers, right, not for the people, is that there's low penetration of insurance in such countries, right, like Indonesia or Myanmar and all that. So may not be so bad. Now, the good part about it is that you have an increased awareness. As I said earlier, it's the last wave. You have an increased awareness of mortality and health risks. Therefore, there'll be a greater demand for healthcare, insurance, and all kinds of protection, right, including stuff like your income protection. Now, just going on to the last few lines here, right? Now, insurance companies, what do they do during this time, right? Government is covering everything. As I said earlier in the first parts of this slide, you can see that insurance companies have been pretty nice about it, especially when it comes to life insurance, right? They provided sort of free COVID-19 kind of cover clients, right? So it involves hospitalization income, which means that, for example, if you're hospitalized for 14 days and all that, right? Then there'll be a certain amount of money paid out to you for every day, right? But this is, of course, if you're hospitalized, right? Self-quarantine, it doesn't count. Okay, so moving forward, what can we expect? You can expect for all your renewals that will come in, policy wordings will be affected, right? You'll be able, you expect that, right? The insurance companies have to be profitable. The review of premium rates is one. Of course, generally speaking, it will be higher. In certain cases, they may not want to take certain deals that are related with trade transactions, right? It will generally be lesser because either the rates are too high and therefore the clients do not want to pay such rates, or basically even the insurance company doesn't want to do it because it's just too big a risk for them, right? So you see a reduce in trade for a while because trade, generally speaking, has to be insured, right? So if the capacity is reduced, the trade will somewhat be affected. Now, for the insurance company, you see more stress testing. They've got to make sure S3 or BGCI group that I'm working for, they've done the stress testing to see if a long-term pandemic happens, how are we going to survive this, right, as a company and not go down, right? And as what Hsien-Hui was alluding to, right, that there'll be acceleration of digitization, right? So you have digital distribution of products, more insurance products will be done online. Internally, the operations will be more digitized, right? And lastly, you will see there'll be more marketing because they have to get back all the money, right? Of insurance via digitization, online and even medical kind of insurance, right? To actually do all this online rather than through the normal method, right? Okay, thank you. Right, I pass back the time to Teck Wee.
Thank you, Jeffrey, for your views on the insurance part of the industry. So for the next part, we'll go back to the survey with the next set of questions. Right. Only 2 questions this time around. What is the education administration of your preference? Whether is it yourself or is it your children, grandchildren? Do you think they prefer home-based learning, classroom learning, outsourced with tutor, or basically some of the students may want to stop school and start a business because they identify certain opportunities? Question 2. One of the beneficiaries of the COVID-19 pandemic is actually our environment. You see we bring in cleaner air and clearer skies. What will you compromise to reduce the carbon footprint? Will you want to commit to stay in a circuit breaker mode, or you rather don't really bother so much, normalize back to the days before the pandemic? You would want to moderate your lifestyle. That one's basically a moderation. And lastly, you want to live your life day to day, but you minimize the international travel. Please vote. Okay, let's look at the results. If it's ready. Looks like everybody wants to go back to school, right? School is actually a combination of learning plus socialization. It's good for the students to interact physically. Also, it's difficult to do webinar whereby we don't know we can't look at the audience and have a feel of how the ambience is. Okay, for number 2, okay, I think most of the survey attendees would prefer to moderate the lifestyle. Nobody wants to stay in quarantine mode. So we all want to have our bubble tea, and our lifestyle while we try to cut back a little bit on certain parts of our life so that the skies can stay clear and clean air as well. Great. Let's proceed to the next, our final speaker for our webinar, Mr. Song Seng Wun. He's a director of CIMB Private Banking, and Seng Wun is a household name. He's a prominent veteran economist as he continues to contribute his professional views on the regional financial markets on a regular basis. He graduated with a Bachelor of Arts Economics and a Master of Arts in Econometrics from the University of Canterbury, New Zealand. So let us welcome Seng Wun.
Good afternoon. Can you see me at this point? Okay, let me start. Right. Okay, I hope all's well, wherever you are this unprecedented time. Earlier, my two fellow panelists have given you a flavor of how things may be panning out post pandemic. This is already when things are starting to normalize. I suppose what I want to start with is the big picture, the initial impact of the pandemic, how it has essentially caused, I think, deep contraction everywhere. Before we can talk about the future, and obviously how that future pans out really also depends on the very important differences in terms of how things pan out will depend on how sustained the recession, how deep the recession will be. Well, this is my fourth recession actually. I started working with my first recession 1985 in Kuala Lumpur. That was oil shock, second oil shock. And since then, boom bust cycle has been about 10 years, roughly. 1998 financial crisis. We had the, obviously, 2008 global financial crisis. And in between, we do have mini cycles. We had the dot-com, we have SARS, we have the first and second Gulf War, we have 9/11. All these caused temporary shock, but not to the extent of a full deep recession that we are currently experiencing with the pandemic-induced downturn. The interesting things that we are seeing with this late cycle of 2010 to today really has been one that is supported by very low interest rate, very supportive government policies, and we were wondering when and how and what would trigger the recession. We were talking about possibility of the trade war, perhaps geopolitics war breaking out either in Korea or Middle East. In the end, it turned out to be a little virus that caused the recession, that puts an end to this very long, mature growth cycle. So here we are in terms of the impact. Obviously, the initial impact is just rolling through. We have seen, obviously, PMI numbers. PMI, Purchasing Manager Indices, you must be mindful of how and what they're comparing. Essentially, they're just survey activities today compared to what it was this time last month. So obviously for China, where the pandemic originated from, it was a case of panic, contraction, everything slammed shut. Chinese New Year essentially was locked down. So China essentially experienced a very sharp pullback in economic activities. And this cycle boom bust is not, again, this recession is not your typical boom bust cycle where you have basically tightening of interest rate policy, monetary policies, government spending a lot less, and then we have the knock-on impact of the contraction on the economy as interest rates are tightened and businesses start to fall up. So the labor market conditions start to weaken. With the pandemic-induced recession, it is shut on the supply side, shut on the demand side, so everything just fell off the cliff, as we saw with the PMI data. And just as the PMI data for China shows, we saw a rebound. The rebound is really from the depressed base. So if there's any V-shape, we can certainly see in the PMI numbers or just survey of business activities, just as business activities are slowly coming back, recovering as lockdown measures are eased, even like in Singapore, as measures are gradually eased, perhaps from the end of this month, starting next month, we will see the PMI recover. But the impact on the broader economy will still persist for a long time to come. And obviously that will really depend as demand and supply condition continue to adjust. And remember, when we're talking about a recovery, when it's maths is quite fun. When you start with 100, 50% fall, you're at 50. When you have a 50% rebound, you're back to 75, but you're still well below the 100 where you have fallen from. So even though PMI numbers have improved, even though businesses are recovering, you are not recovering to where you have fallen from. So there will be businesses that will continue to fail, and labor market conditions will continue to weaken in the months and quarters ahead. So the next 1 to 2 quarters will be very important, and that will really tell us how severe this recession will be, which is why the IMF calls this the great lockdown recession. This set of forecasts over here really is just their baseline, but obviously there are many layers of crisis developing across many countries around the world, and much will really also depends on how strong or weak the healthcare system is, and therefore the likelihood of little clusters of outbreak can still be risk to a full recovery going forward. So because of that, and because of the uncertainty as to how things can normalize, forecasts are going to be just all over the place. We can look, for example, here in Singapore. Let's say the circuit breaker is, say, ends officially June the 1st. But what does that mean? Just think, are you all going to be going back to the office? Are you going to be practicing safe distancing, say in office lift? So what does that mean when you try to enter the building and get the lift? So obviously it will be very phased in that sense. And that's just within Singapore. When will travel, cross-border travel, global travel be normalized? So all these things, as long as we don't return to normal, it essentially means that cap to full recovery remains, and there are still risks as far as the outcome. So this is the forecast that we see for country so dependent on trade in goods and services like Singapore. The line on global trade volume is expected to contract by 11% this year. It could be more than that. And then you just say, oh, 2021 looks good. But again, as I say, you're not and will not be able to return to where you've fallen from, at least for the next 2 or even 3 years itself. Now, other risk behind us is that because we are coming into or going into a deep recession from a late cycle, a late matured cycle, which has been propped along by very, very cheap interest rate, debt has been piling up. And this is an example of just emerging and developing Asia external debt. Obviously, we have lots of debt being piled up by corporates as well. The only good thing we can say in this downturn is because interest rate is going to be staying very low, or for some country even negative, that will help them in the recovery side in terms of payment, in that they're not going to be killed off by rising interest rate. So if there's any consolation of this debt burden, it will be interest payment will not be the big sort of leg drag on the recovery itself. But nonetheless, this is a vulnerable spot as far as the cap on the recovery because of the debt level. Now, coming back here to Asia and the region, obviously for Singapore, as we said, it's very trade dependent. So we are going to be feeling the full force of the downturn as far as second quarter. This table was done up before the risk of some of the 1Q data, and they're mostly in line, although like Malaysia, we had 1.5% for first Q, it came in half of that. So for Malaysia, Singapore, and Thailand, we are basically almost close to, or in the case of Singapore, double-digit contraction, very severe. And so obviously the implication going forward, as you can see, a contraction of that magnitude, full year of at least 5%. This is baseline, so there's a lot of error around this true path of the data itself on the labor market condition. Hopefully, with the measures in place, measures that are being rolled out, measures which perhaps may still be rolled out, we're able to keep business failure and unemployment jobless rate down. Even if we keep it down to say 6%, which was the last high of the worst of the labor markets of back in the previous crisis, 6% of labor market, I suppose in the context of how labor market condition has weakened far more significantly elsewhere, double digits in other countries, 6% in Singapore still means for a labor market of 2.5 million, you could potentially see 150,000 jobless out there. So it's a very significant number, which will continue to be a weight on recovery of Singapore, just within here, without the lift from external side. So this is something that we have to I suppose, bear in mind. Final slide, so essentially is still all about government, central bank, trying to sort of contain the fallout of a recession that is still deepening, which is why markets have sort of ebb and flows depending on how those policies and measures have been rolled out, part-time, sometimes lifted by hope that the measures will help to revive economies. But as long as restriction remains in place, as long as we're not able to sort of travel around freely, as long as businesses will not be able to say, oh, I'm going to come down to Singapore, put money on the ground, open up factories, etc., there will still be a risk. Obviously, the risk in the coming days and weeks and months will be from reopening risks. We've seen that already, be in Germany or in Korea or in China. Although with social distancing in place, the second wave, maybe third wave, will be slower, as long as we all wash our hands and wear masks to the office as well. But at least the whatever it takes approach will help. Do remember, the government and central bank around the world has been prepared for a downturn. I mean, here in Singapore, if you recall, central bank, even 2-3 years ago, were already tightening measures to prevent excessive borrowing. Remember the property market? They were tightening the measures all the way through. Credit cards, credit cards essentially requirement also tightened. Basically, we were all worried that we are entering into a late stage growth cycle. We don't know where the recession could come from. What's a black swan event that trigger a recession? In the end, as I say, it's a virus. So we are in that sense better prepared in that we are going to see a very sharp downturn, but hopefully we will rebound just as quickly. But obviously, how quickly depends on many things. And all those things that has been talked about by my fellow panelists earlier are the potential for the new economies. But for now, for the immediate nature, it's really all about the recession that is going to be jeopardizing jobs, livelihood of many, many millions of people around the world, especially in the emerging developing economies. For countries we are very dependent on remittances, we're talking about the Philippines, Indonesia, or even India, their countries are vulnerable. But for now, if we were to wrap up with markets and outlook itself, market is trying to look past this recession. But I think we still don't know how it will pan out. Even companies are reluctant to give, I suppose, guidance if the latest earnings results and anything to go by, unless they are obviously in areas which has benefited from people being forced to stay at home, for businesses who have to forced to go online, like this webinar itself. So all these things, I think, will still create opportunities on one side, but as long as the recession continue to unfold, I think there are risks. But obviously, when we come out of the recession, it is a new growth cycle. There will be plenty of opportunities for a new growth cycle, and some of those will obviously be shaped around the digitization process and technology, and essentially many more businesses will be created in the new growth cycle whenever that begins. So on that note, I will pass it back to Teck Wee. Thank you so much.
Thank you, Seng Wun, our economic expert. Before we commence with the Q&A session, can we go through the last round of survey questions? Okay, there's only one question. If you have $1 million to spend or invest, what would you buy in July, which means after the lockdown is over? Do you buy stocks? Do you buy up a struggling business at a discount? Real estate? Or keep it in your biscuit tin because you don't trust anything anymore? Interesting times. And of course, that's if we have 1 million to spend, a wish list, right? So I think the findings should be ready in a short while. Wow, interesting. Our attendees are very confident of the capital markets. 40% will still go back to the stock market to buy shares. Fantastic. Good news for the stock exchanges. Of course, 31% are more conservative or rather more comfortable with real estate, even though the prices are still at a pretty high level. And interestingly, also we saw 20% have lost confidence in everybody and anybody. So your best investment mechanism is actually the biscuit tin. Congrats. So, okay, let's proceed to the next part, more interactive part of the session. Can we invite all the the three panelists back with video and unmute yourself? For the delegates or the attendees, I'd like to set the ground rules. Those who have not posed your questions, please click on the Q&A icon at the bottom of your screen. We will try to address as many questions as possible. Right, so without further ado, let's begin with the Q&A session. So we have a first question, is investment question. What is the market, or rather the stock exchange and sector with the highest potential and highest risk? Is it still relevant to hold on to a portfolio if the fundamentals or the economics have changed?
Okay, I suppose the question is directed probably at me because I'm holding the investment title in my that's what I do. Let me qualify what I'm going to say first by saying that I specialize more in private equity and venture capital, and I'm less familiar with public equities, which follow a completely different mechanism and a completely different subject to completely different market forces, in which case I think Seng Wun probably is better placed to answer that question. My take is that there's a lot of, obviously the highest risk is in hospitality. If you ask me, hospitality will face the highest risk simply because it is the most, it is the sector which people don't pay a lot of attention to. When the government says, we're going to bail out Singapore Airlines, it says we're going to bail out the national carrier, we're going to bail out Boeing, we're going to bail out Airbus. No one talks about bailing out a hotel chain, or no one talks about bailing out, some of these hospitality chains or F&B outlets. And I think therein lies the biggest risk, but also it could provide the biggest potential, because those that can survive this particular period with the right fundamentals, with the right injections of cash, with the right product market fit, with the right channels to the customer, might have the best opportunities moving forward, because their stocks are likely to be an all-time low. SIA went to an all-time low today. If you look at the hotel shares, you look at those that are doing not shipping, what would they call it? Those cruises. Those are something that you may want to take a look at. I'm not saying that you should put money into it. I'm not a financial advisor by any means, not qualified to do so. Caveat is that everything is just my opinion here. Those might be something worth looking at, especially those that have the capability of the cash flow and the financials to weather out a 24-month period. I'm not sure many of them have that, but I'm looking at probably a 24-month period before things get back to normal, and then you're going to see a rush of people trying to get on board leisure activities again. I don't think that's something that inherently in people is going to go away, whether virtual reality or whatever takes over.
Okay. Any other comments from other panelists?
Okay, perhaps I can just add a few words on top of Seng-Hui's view. Again, is if we are not quite sure of the severity or how long this recession will be, one have to, in that sense, save bullets. I find it very interesting in terms of response, in terms of will $1 million will go back to the market in July. Could well be right, but I think again it depends on one risk profile. I'll be a bit more careful and say spread that 1 million loot over maybe 5 tranches, and then trade on that, because I would say there will be opportunity that will come along. A recession typically unfold over a year and a half, 2-year period, and impact on businesses as they unfold really depends on the individual companies in those respective sectors, whether they are adversely affected or otherwise. And I think this is where a lot more homework has to be done, and paying attention to what's happening on the ground matters a lot. But I think the simple message would be don't rush in when things are still as unclear as they are at the moment. Spread them out. I would say you have time. Pass it back to you, me.
Okay.
Actually, if I may, I wasn't given the privilege of answering those little questionnaires that you had. But if you ask me, I would keep the $1 million in a biscuit tin in July, because I will wait to see what happens. Honestly speaking, too soon to put it into any of the other financial instruments. My personal opinion.
Yeah. Maybe I add on to that, right? I think if you read, a lot of economists are talking about, or some actually are talking about this kind of a V-shaped kind of recovery. I don't think that is going to happen, right? I mean, we had a huge drop coming down, and then expecting that, once, we're all let out, this thing is going to go straight up, right? And suddenly you're going to find a lot of multi-millionaires. You put in $1 million, it becomes $10 million. I think you got to tread very carefully with this, right? Because this thing about COVID-19 is that it could have a second wave, who knows, a third wave. And so there's a lot of uncertainty in the market, right? I'm saying this from an insurance standpoint, right? Because insurers are also very careful moving forward as to what to insure, right? So even us, as insurers are looking at it. So as investors, you're also looking at the same kind of risk, right? So I would suggest caution and a lot more work before you feel that you're plonking that $1 billion somewhere, right?
Okay, a follow-through question. Since Hsien-Hui or even Seng Wun also mentioned, and Jeffrey said that your best investment mechanism is actually the biscuit tin at the moment. Would there be a trigger event, like maybe the invention of a proven vaccine, to be the so-called the alarm bell for you to actually start investing, or any trigger events for all the panelists to answer?
Yeah, I suppose I would consider, but I suppose even before then, you certainly would have getting news that there are promising drugs out there. We may be doing the job itself, but and certainly we are not doctors over here. Process may be shortened. We're still talking about process perhaps of a year. So we are still perhaps talking ahead of ourselves at this point. Certainly is until such time as you see businesses having some clarity on where they are heading to, I think that will be certainly a sort of sign of some bottom being reached for the market.
I think for me, the key indicator is going to be the unemployment figures. The moment the unemployment figures start to level out, it may be time to start to monitor which areas the economy is going to start to grow. And then it's sort of about will the vaccine create opportunity? Yes, for sure, but it's not a panacea. It's not just because there's a vaccine does not necessarily mean that the economy is going to recover overnight. It's going to take a period of time for all the processes that have been put in place to unwind, for people to get used to working with each other again, to travel again. So there's quite a lot of things that need to happen. So I know the stock market is always ahead of reality, but sometimes you've got to be careful how far ahead we need to look.
I agree with my fellow panelists, because at the end of the day, you may have the vaccine, but then there's this issue of distributing it, right? And getting it into everybody's system, right? This is going to take time, right? And for all you know, it also may not work fully also. So there's also that risk there. It's not risk-free in a sense, right? So, but if you ask me, right, I mean, if you ever had that chance and you knew it beforehand, then fine. I mean, that could be a good place to plonk in your $1 million. But having said that, do it with caution. This kind of vaccines are not 100% guaranteed, right? And then if you have mutations in this COVID-19, then there goes your stock value there, right?
And there are other risks as well. Just a final point, I suppose we're going to talk about the US administration's policy. If President Trump gets re-elected, I think war with China is still very much on the table. So that risk remains. So if there is one thing that still worries me is post-COVID, or even during at this point, is the US-China relationship on all fronts, whether it's competition on technology front, whether it's soft power, politics, etc. as well. So that still remains very much a risk on the table. So plenty of things to still watch out for besides just vaccine in the meantime.
Okay, good. We have a next question. With the earlier survey findings that hospitalization insurance are most sought after, is it prudent to upgrade the existing hospitalization policy, even though the clauses for the new policy would have been tightened?
I guess that question is for me, right? I like Hsien-Hui, right? Hospitalization insurance is not my particular field, but maybe let me say a few words about this, right? Particularly in the Singapore context, right? If you're Singaporean, you have the MediShield life cover, right? So that covers the basic cost of hospitalization. I guess if you want to feel safer and more comfortable, then you can, there are riders that you can buy. But having said that, all Singaporeans are covered. So it's more for at your comfort level that you want to put in, riders, for example, to cover the taxi fare, maybe even the cost of the ambulance and all that. That's most probably not included in this, right? So you could add those riders in, right? No harm adding in. I think this might be actually a good time to do it also.
Okay, any comments from other panelists? Or we proceed to the next question? Okay, there's a lot of...
I'm not qualified to answer that, so please go to the next question.
Okay, there are a couple of questions actually pertaining to US, about US presidency. How would Donald Trump affect the global economics, specifically in Singapore?
Well, I suppose I could take it from a macro side in that the US is still one of Singapore's largest investors, and it will still likely to remain so. But Singapore still continue to be a neutral zone, and to do so, we have to be, I suppose, show similar hands to all parties to make sure that Singapore continue to receive investment in the coming years. So I think it will always try to strike a balance at the end of the day. We are in Asia. We are in a zone where growth momentum will be strong. but we're also aware that the geopolitical risks will always still be there, especially when it comes to the US relationship. So Donald Trump, if we look back to the US side, at this juncture, in my view, is still all about re-election. So all he is doing now is trying to repeat his earlier 2016 campaign of making America great again. This time, it is about creating the environment to I suppose blame somebody else, and in this case China, if the job isn't coming through, if America is weakening underneath because of the virus. So he's playing, I suppose, a game, which obviously for the rest of us is going to be meaning a very volatile environment, not just today, tomorrow, but even into the November election, if that's going to be held, probably will be, and even beyond that. So important, as far as the US is concerned, is still the superpower #1 in the world, and likely to remain so during our lifetime. Next lifetime, it will be China, but well, we're not around to talk about that, but perhaps another forum.
How about US dollar, which is actually a global currency for trade and all kinds of businesses?
Yeah, I think again, interesting. It is the #1 currency of trade. It is the settlement of second currencies. So I would say at this juncture, it still retained that safe haven status. So which is why we have seen, despite all the ups and downs, it remains strong. Just like in a sense, Japan, safe haven status, even it is going through one of its deepest recession now, the yen continues to hold up because it's safe haven. The flip side, obviously, is if you think going forward that the US central bank may pursue a negative interest rate policy, don't think that will happen, but we should never say never. President Trump got elected. If we do ever get negative interest rate, it has to be very significant in terms of the backdrop in the US for them to do so. It basically means that gold will suddenly be the last, I would say. I'm not talking about Bitcoin. I'm not expert on Bitcoin or cryptocurrency, but suddenly gold may be seeing, a mega lift in that kind of environment of negative US interest rate. Don't think that will happen, but for now, as long as we are still looking for safe haven, it is Milo Tin, Sing dollar, that much inside there, but it's still going to be US because that's still the currency of choice for now. I don't know whether Seng-Hui and Jeffrey have more to add on that side.
No, I think we are pretty much in agreement with you on that. The US dollar is not going to be changed. Going to change overnight. And the RMB is a non-liquid currency, so it's not going to replace the US dollar anytime soon. And crypto, from a technology perspective, is fun to play with as a store of value and all that. But when you try to actually take it out and all that, there are a lot of other issues surrounding it. So it can be part of a diversified portfolio, but definitely not one that I would recommend for first-timers to go into.
Okay, we have a series of questions, so I will lump up the questions into one. There are a few sectors that have been in focus over the last few months. #1, retail. #2, healthcare, tech, aviation, and oil and gas. This is basically for all the panelists. What are your views on these sectors, and would they have a situation whereby any of these sectors will actually be eradicated by this pandemic situation moving forward, and which one will actually thrive?
I think Seng-Hui should start the ball rolling.
Yeah, okay. Quite a few. So I think I'll address the tech sector for sure. If they are providing the right product for the right people in this current environment, they are going to be the ones where the most opportunity lies in. I definitely don't think the tech industry is going to be eradicated by COVID-19. If not, it's the reverse. They are probably likely to be the ones to drive future economic growth in the near term. Retail has got to reinvent itself. No two ways about it. COVID-19 has shown that they do not need to rent expensive real estate in the city area when they can actually be located elsewhere and just sell most of the stuff online. And what were the other areas? I'm sorry.
Aviation.
Aviation, healthcare, oil and gas.
Yeah. Oil and gas.
So I think oil and gas, energy is energy. I mean, at the end of the day, the oil price can fluctuate. There may be a glut of oil at this point in time. Energy is energy. If you look at the long term, it will sort of come back up again. I don't think that oil companies are overly concerned about this little blip. You don't see them. We are very close in contact with the likes of oil majors. None of them are being overly concerned. They are still rolling out programs that are not related to the core. So I think oil and gas is not going to be, are going to worry too much about this 1 or 2 year cycle. When it comes to mental wellness, mental health, I think that was one of the sectors. That one, given the situation, the close proximity, possible family tensions, then the looming recession, I think that's a sector that's going to need to hire quite quickly, professionalize the people that they bring in to cope with quite a rise in the number of people that are going to need their services. So yeah, I'm not sure what other areas are there. Do you wish me to talk on?
I suppose for aviation, it's really all about whether, when countries going to lift travel restriction, and obviously that will be when we'll see aviation and hospitality being able to recover. But as long as we see restriction in place because countries are fearful, we just need to look at Singapore, for instance. As long as we are not sure it's safe to let too many people come through either for work or for leisure, then it is still going to be a drag as far as whether Singapore Airlines is going to be recovered to where it used to be, or whether the hospitality sector will recover at that stage as well. So it could be a fairly long, bumpy road ahead. Even if we were to see vaccine coming in, we're not sure whether there will be other viruses that could come through. If we have learned from this thing is, there can be other kind of outbreaks and diseases, and therefore those remains the risk for, I would say, aviation and hospitality to be able to recover to those kind of highs that we saw before.
Maybe I add to this mental health, wellness point, right? Now, if you look at the times during the Great Depression, right, the suicide levels increased almost 2-3 times, right? So this is going to be a serious issue moving forward when we are all stuck at home and some not being able to find jobs and just feeling plain old cabin fever, right? So I believe that particular industry requires more people to step into it. It requires more development, right, to save lives. That's one. Aviation, the way, from at least from my standpoint, is that it will finally still have to pick up in some form or fashion, because flying is part of life now, right? So I think there's a huge supply now, empty seats, empty planes, but it'll slowly pick up. And if you're thinking about whether the prices of tickets will increase, I think initially it will not be so high. And generally, when it picks up and you have to put in all the other safety measures, then moving forward, you could expect higher cost of air travel, right? Because lesser people can be moved around. So it's here to stay. It's as what Seng Wun and also Hsien-Hui has said, right? At the end of the day, it depends on how long this particular pandemic lasts, right?
Okay, I think we are coming to the last question. This one is actually more pertaining to Singapore, because around the world, actually, we do see governments of the world stepping in to save or try to salvage businesses from laying off people so that the unemployment rate is kept low. Question number one, is the government the solution to being an insurer, a banker, a social worker, and everything? Basically, it's one government takes on all the roles. And number two question, is the economic cycle bottoming out, or is there any more downside to go?
I suppose I'll start it off again. As I said during my presentation, I think the next 1 to 2 quarters will be critical for whether this is, I will still say this is probably going to be a hockey stick, so a kind of a recovery. I said we don't know how long the tip is going to be. So the next 1 to 2 quarters will be key, whether it's a reinfection rate or whether there's a vaccine developing, etc. As well. So it's very how deep the recession will be. So coming through, I would essentially they'll say that then when the recovery were to come through, it will be still very much dependent on the public sector doing the heavy lifting. Everywhere around the world now, when you have private sector consumption in terms of investment, in terms of putting factory on the ground or businesses on the ground and hiring, that is essentially slowed down significantly unless you are in those essential areas which have seen the lift. We know, and I think we have mentioned many of them already. But generally, these are not able to compensate for the sharp drop in the other economies, whether it's broader manufacturing or broader services. So government has to come in to sort of do the heavy lifting. The government share of GDP is tiny, but nonetheless, they will still be rolling out, which is why if we're talking about Europe, US or China, or in Singapore here, we are seeing government roll out measures to essentially try, as you pointed out, everything to help businesses retain workers. Obviously, if you can retain workers, prevent the unemployment rate from rising or the numbers from rising, it at least means that there are going to be people consuming, of course, although it's more digital at this juncture. If they can do that, unemployment rate or number can be sort of in a sense capped. But obviously, for Singapore here, we are so dependent on external demand. Trade in goods and services is 3 times the size of the economy. So as long as they are constrained on that side, our lift is really only going to be from internal demand. You and I and all the participants today just doing our bit, either clicking online or going down the Tapao, etc. So this is not enough to compensate for what happened. We're talking about, let's say, Singapore. I'm just rounding it down, $500 billion economy, which basically translates to very simply, say roughly around 1.5 billion a day. And therefore, the harm of every day for COVID circuit breaker could be in the order of up to, let's say, 30–50% now, maybe half a billion, 500 million per day, for instance. So where is the lifting coming from? It entirely has to be coming from the government side. So that may continue to be the case, I would say, going forward until, as Seng-Hui pointed out, the labor market condition recover, which means private sector start hiring again because they are more confident about the order flow, more confident about expansion, whether it's within the region or outside the region. So to me, is government, whether it is central bank or whether it is the government fiscal policy, they will continue to have to do. Which is why, interestingly, the U.S. central bank governor, the Fed chair, continue to ask the U.S. government to do a bit more of the heavy lifting, primarily because the Democrat and Republicans still haven't been able to come together to agree on what kind of help is still going to be needed for. They need a lot more, because they're heavily indebted already. They're actually issuing a ton of debt paper, but they're the number 1 economy. So it is going to be government funding as well as central bank policies will do the heavy lifting going forward, and we may remain for a lot more longer than we think.
Let me sort of add to what Seng Wun is saying, right? Yeah, no doubt the government has to do the heavy lifting, but there still has to be a little bit of private and with the public-private kind of collaboration, because we now have, for example, the job support scheme and various support schemes, subsidies and all that by the government, which is very good. But some of these decisions within the companies itself, for example, small and medium enterprise, they employ about 70% of the workforce in Singapore, right? So you've got all these bosses that are around, right? So their decisions to preserve their wealth, or to say, okay, look, I can't lose so much and all that. So all this is got to do slightly also with a little bit of education, a little bit of appeal to them to actually say, hey, look, during this time, put your lot in with us, so don't have to make so much money, or you made a lot before, then maybe this is the time to help others and all that, right? So I do agree, the government has to take the lead. The government has to set the policy, has to set the tone, and also we as Singaporeans have to play our part, right? So, for example, in NUSS, we do sit down, we find ways to handle it. It is not purely working on what the government has provided. We also have to come up with ways and means to sort of survive during this period, right? So I guess that's my point. It cannot be a pure government kind of a situation where they come in and do everything.
Do our parts. Yes.
Yeah. Let me just quickly round up. If you notice, the bulk of the Singapore policies announced recently can fall basically into 4 buckets. One is food security. They want to make sure, these are Maslow's lowest level of hierarchy of needs. Make sure that the food is there. Minister Masago said that Singapore needs to at least have 30% of food supply locally by 2030, and that there is a risk that was identified during this COVID-19. The second one is shelter. So that they have deferred they have been allowing people who cannot make payments on their house to defer it for a year, which I suspect is part of the reason why the housing prices have not collapsed as probably we expected. The third, obviously, is the healthcare, trying to make sure that people get masks and all that. And the fourth is employment. So I think most of the policies you find that they have funding and all that are to establish that kind of foundation, and hopefully the private sector can then take this as a basis from which they can then continue building their businesses, because the government can't do everything. And even if they try to, they will do it badly, because the government does not specialize in the go-to-market.
True.
Okay, thank you, gentlemen, for the most interactive and engaging session. We try our best to answer as many questions as we can. So thank you for your efforts. Ladies and gentlemen, we hope you enjoy this webinar. For the last thing we need you to do, please do this quick feedback survey so that we can, based on the survey, to improve our next and future webinars. Survey, please. Okay, so we'll show you the findings after this. Overall, how do you rate this dialogue? Did the dialogue improve your purpose of the event, broaden your knowledge, invest your time in useful learning? Prior to the event, you got all the information about the event you needed. This must be one of the most challenging seminars ever, because we are all speaking to our laptops. We don't even know who we are speaking with. Yeah, so I'm sure, I hope your the panelists, if you enjoy the session, is a little bit like it's a meeting, whereby we can sit together and have drinks and talk about coffee talk. But yeah.
I like technology, but given the choice, I'd much rather do this in NUSS Kent Ridge Guildhall or something like this. Yeah, this is a very awkward way of speaking.
Yeah.
Good.
So do we have the findings for the survey? Let's see. Okay, So we have a broad range of findings. Mostly agree it's very good. So I think 92% thinks that it's more like a training. It's very good knowledge acquisition. That's great. Okay, we got your feedback. Thank you so much for all the attendees. We hope you enjoy. We will be posting the webinar on the YouTube NUSS channel. Look out for it. We'll send you an email on this. Thank you so much for your attendance and your time. Have a good evening.
Thank you.
Thank you.
Thank you.
Thanks, everyone.
Thank you. Thank you. Bye. Bye.
Bye.